In July 1991, India loaded 47 tons of gold onto a plane at Mumbai airport. The gold went to the Bank of England as security for an emergency loan. The country had enough foreign currency for only about 3 weeks of oil imports. 35 years later, gold is again at the center of an Indian currency crisis. Families are buying it to protect their savings, while the government is trying to slow those purchases. At the same time, expensive energy and weaker demand for outsourced tech work are pressing on the same economic structure. Why did a country known for rapid growth become so exposed to these shocks? To understand the pattern, go back to that flight in 1991. India had already sent another 20 tons of gold to Switzerland 2 months earlier. The gold helped secure an emergency loan from the International Monetary Fund. India needed the money to keep buying oil. The first Gulf War had pushed oil from $17 a barrel to $46. India imported 85% of its crude oil. The Soviet Union then collapsed, cutting another source of supply. Foreign currency reserves fell to $1.2 billion. That covered only 3 weeks of oil imports. The crisis pushed India to open its economy. The government reduced limits on business and welcomed foreign investment. Yet, policy changes did not remove the practical barriers facing factories. Getting land could take years of approvals and court cases. Local groups sometimes opposed projects or made new demands after talks had begun. Local politicians often sided with those groups because they needed their votes. Weak schools, limited electricity, and poor infrastructure created more problems. Manufacturing grew, but not fast enough to transform the economy. Services faced fewer of these barriers. India had a large English-speaking workforce because of its colonial history. An outsourcing office needed less land and heavy infrastructure than a factory. It could also operate from a major city. Foreign companies began moving customer support, software work, and other services to India. For about 30 years, that model supported rapid growth. Services now make up more than 55% of India's economy. Manufacturing remains near 13%. Vietnam's manufacturing share is about twice as large. This difference matters because factories can employ many workers with different skill levels. India's IT and outsourcing boom helped create about 15 million urban middle-class jobs. But only around 10% of workers have formal social protection. More than 55% still work in the informal economy. A small manufacturing base also means importing more finished goods. Service exports bring dollars into India, but they have not fully covered the trade gap. Paying for imported goods creates steady demand for dollars. Over time, that puts pressure on the rupee. When Narendra Modi became Prime Minister in 2014, $1 cost about 60 rupees. He often blamed the previous government for that weakness. By May 2026, the rate had reached about 95 rupees to the dollar. The rupee had lost close to 40% of its value in 12 years. That long fall helps explain the demand for gold. In 2014, gold cost around 2,800 rupees per gram. By 2026, it was near 15,000 rupees. For a family worried about inflation or a weaker currency, gold can look safer than cash. The amount held by Indian households is enormous. A 2025 Morgan Stanley report estimated about 34,600 tons, worth $4 to $5 trillion. That was more than the official gold held by the world's 10 largest central banks combined. But India produces only about 2 tons of gold each year. Most household demand must be met with imports. Gold accounts for around 11% of the country's imports, second only to oil. Here, a sensible choice for one family can create a national problem. Buying imported gold uses dollars. That adds pressure to foreign currency reserves and the rupee. A weaker rupee then makes gold look even more useful, which can lead to more buying. The energy shock of 2026 made this loop much harder to manage. On February 7, India signed a trade agreement with the United States. India agreed to stop buying Russian oil in exchange for relief from extra American tariffs. That increased its dependence on supplies from the Middle East. Around the same period, India seized 3 Iranian oil tankers. Modi also visited Israel 3 days before an American and Israeli attack on Iran. These choices suggest that his government expected the Western powers to remain the safer side in a crisis. The following weeks showed the risk in that bet. Iran closed the Strait of Hormuz on March 4. The closure caused a huge loss of global oil supply. Brent crude rose from $68 before the conflict to $119 a barrel. India then faced fewer imports at much higher prices. Its oil imports in March fell 17% from a year earlier. Refinery use dropped, and supplies of cooking gas fell 16%. Some areas limited purchases. The effects were visible in daily life. People waited in fuel lines under temperatures close to 50 degrees Celsius. Some restaurants used coal when gas was unavailable. Some tea stalls turned to firewood. On March 16, India released the Iranian tankers and accepted other conditions. Iran then allowed several Indian oil ships to pass. Heat made the shortage more dangerous. In May, northern India reached 48.2 degrees Celsius, a local record. A 2025 report from the International Labour Organization said about 380 million Indian workers regularly faced extreme heat. That was roughly 3/4 of the workforce. Energy costs. heat, and the currency were now feeding into one another. India spent $38 billion of foreign currency reserves in 3 months. In January, its reserves could cover more than 11 months of imports. By May, that had fallen below 8 months. 10 months is often treated as a basic safety level. The central bank used dollars to support the rupee, while the country paid larger energy and gold bills. The rupee briefly passed 96.5 to the dollar. It was down more than 7% from the start of the year and became one of Asia's weakest currencies. Foreign investors were also pulling money out. India lost $19 billion of foreign investment during all of 2025. The outflow in the first quarter of 2026 alone reached about the same amount. Major global funds reduced their share of Indian assets to the lowest level in almost 10 years. For households, these signals made gold even more attractive. The Indian gold price rose 81% from a year earlier in the first quarter. That was 11 percentage points above the international rise, mainly because of the weaker rupee. Gold imports reached a record $25 billion in the quarter, almost twice the earlier level. The Reserve Bank of India reportedly sold between $500 million and $800 million a day in offshore markets. It also stopped some banks from financing gold imports. On May 13, the government raised the gold import tax from 6% to 15%, its largest single increase. Demand still rose. Gold imports during the first 2 weeks of May were 22% higher than in the previous period. Many buyers expected the rupee to weaken again, so the new limits gave them another reason to act quickly. Modi asked the public to avoid buying gold for 1 year. He also urged people to work from home, use electric vehicles, and reduce air conditioning. These steps could ease demand for imported energy and gold. They could not repair the deeper structure behind that demand. That structure now faces another test from artificial intelligence. India's service model depends heavily on foreign companies paying for routine office and software work. Generative AI can perform some of the most standard tasks in that work, including writing code and testing software. In April 2026, employees lined up to complete departure procedures outside Tata Consultancy Services in Bangalore's Electronic City. TCS is India's largest IT outsourcing company. Its dollar revenue fell for the first time since the company entered the stock market in 2004. The change was wider than one company. India's 5 largest IT firms had added an average of 50,000 employees a year during the previous 5 years. In the first quarter of 2026, their combined workforce fell by about 7,000. India built this industry on English skills and lower labor costs. Over 3 decades, it gained more than half of the global outsourcing market. About 5.8 million people now work in the industry directly. AI does not mean all of those jobs will disappear, but it changes how many people a company needs for standard tasks. In April 2026, the research firm Bernstein said IT and outsourcing workers were among the first groups exposed to generative AI. It estimated that the Indian workforce in this field could shrink by 1/3 within 1 or 2 years. Technology companies in Bangalore expected as many as 1.8 million job losses over 18 months. That is a forecast, not a measured result. Still, financial markets were already reacting. TCS and Infosys each lost more than 25% of their market value in the first quarter. IT became the weakest part of the Indian stock market. Moving from outsourced services into advanced AI production would also be difficult. Large AI systems need computing power, advanced chips, and reliable electricity. These are areas where India's manufacturing and energy systems remain weak. Modi has promoted Make in India for a decade, yet manufacturing is still around 13% of the economy. Building a chip industry can require at least 20 years of knowledge and tens of billions of dollars in steady investment. Large data centers also need a stable power grid. India's foreign policy created another limit. It moved closer to the United States and Israel, but was still left outside American access to some high-end chips. At the same time, its relations with Russia and Iran became more difficult. The result was less freedom over both technology and energy. These economic problems have not yet removed Modi's political strength. On May 4, his Bharatiya Janata Party won 207 of 294 seats in West Bengal. It was a major victory and strengthened him during his 3rd term. National and religious messages can help a party win elections. They do not directly create factories, stabilize a power grid, or replace lost outsourcing work. Those tasks require slower changes that may take many years. The gold flight of 1991 was a warning about oil, imports, and foreign currency. The gold buying of 2026 points to many of the same weaknesses, now joined by extreme heat and AI. This does not prove that India's growth has ended. It does show that growth built mainly on services can be fragile when energy becomes costly and technology changes the jobs that services once provided. The popular image of a simple race between China and India misses that structure. India's future will depend less on a slogan about rising power and more on whether it can build factories, energy systems, and jobs before the next shock arrives.